What's going on, guys? In today's video, I want to go over with you my swing trade on Dollar Tree DLTR that made me around $155 in just a couple days. And if you average out the return, it comes out to $12 a day in passive income. If you're new to the channel, my name is Ethan Chase and I post videos every single day of me trading the stock market and weekly videos on personal finance, investing, and life. If you haven't already, hit the subscribe button so you're notified about future videos in the future. The swing trade I'm going to, and one of my favorite strategies I like to do, is essentially short a stock when it's overextended, and I'll explain why that kind of works. By the end of this video, you'll understand what the strategy is and how it kind of operates. A first kind of prerequisite before we hop in is to understand that the market moves in twos. So let's say you have a stock, it goes up, but in order for it to keep going up, it has to come down a little bit first. There has to be a pullback, and I'll explain why. On the move up, okay, that means, so let's say, I don't know, let's say the stock was kind of like that. It's just kind of sideways like that, okay? So that's before the stock broke out. So people bought it, okay? People bought it and maybe sold it, but let's assume people bought it in here, okay? So people were buying that stock right there. When it finally breaks out and moves up, that means those people locked in a profit, right? They have an unrealized gain, assuming they haven't sold the stock yet. And what needs to happen is those people need to lock in a profit, because if you don't want to keep profit on the table, right? You want to lock it in, cash it out, put it in your bank account essentially. So what's going to happen is inevitably this stock price has to come down, because the people who bought the stock here and had that unrealized gain, they need to realize those gains by selling their stock, by increasing selling pressure, so the stock has to come down. So that's the first part. The second part is then the stock, assuming it's a fundamentally good stock, the stock will go back up. And the reason why it goes back up is because the people who missed out on the initial move up, they're waiting for a pullback. They're waiting for kind of the stock to sell off a little bit so they could have a proper entry point into the stock. And that is really this kind of point right here. And of course, it's hard to predict that, but that's what happens. That's why the stock market moves in two. It either goes up, sells back down, and then allows for another round up, or it sells down, people lock in profits, and then it comes back down again. So that's kind of the market theory. So in this example for Dollar Tree, we have an idea where the stock moved up too much and it had to move back. So as you see in kind of, let's see, this area, the stock moved up. So it had that breakout, right? So let's draw that. Let's kind of just keep the analogy. So you have this kind of sideways trend. Okay. We have a little trend. And then the stock breaks out. So in this stock, you have the sideways trend here, right? You have that sideways trend, and then the stock breaks out. So that's what we have here. Now, when the stock, breaks out, it has to come back down, right? Because people need to lock in those gains. So people who bought the stock in this range right here, they have an unrealized gain, so they need to lock in their profits, right? So what I do is I'm looking to profit on the way down. So when the stock moves up, I'm looking to enter pretty much at the peak and ride the momentum down. So my job is to short the peak and ride it down. What I'm doing is essentially providing liquidity, right? In order for those people to lock in their profit, they need to sell the stock, and there have to be people who are willing to take on those shares. And for me, that's by selling and shorting the stock. So we're kind of doing a transaction where I'm providing them the liquidity for them to lock in their profits, and I also stand to benefit if the stock goes down, which I think it will. So I hopped in on Dollar Tree on this candle right here, the last one. So this is what I saw when I entered the trade, and it was a swing trade, so I intended to hold it for a couple days. So I entered at the far most right candle, the most recent candle, which is May 29th. I shorted 20 shares at $97.27, so around $1,000 position, give or take. And my bet was that the stock would go down, right? So we know the market moves in two. The stock just kind of ripped up really high, and now it has to come down. And if it comes down, I will profit. And if you take a look, drum roll, boom, it came back down. And this was a more kind of exaggerated sell-off than I anticipated, but it was supported and kind of assisted by the market selling off because of fears of a second wave of coronavirus, but that's always a good. But essentially, sellers who bought in this kind of range that we discussed, they locked in their profits, and the stock kind of just went down. A good thing I just noticed actually, and this is a daily chart. This is all days. This candle right here is a very good sign. I'll explain why. This candle right here means people try to move higher, but there's just too much selling pressure. There's too little demand or too much supply that the stock just came down. And that's usually a good indication that the trend is reversing. So instead of continuing higher, it's probably going to roll over and start coming down, which is what happened. So that was a trade. I exited on June 11th, which is this candle right here. So if I held it, I would have made a little bit more money, but it's okay. It was kind of closing this gap here, but I sold it on this day. I sold 15 shares at $89.64, and then 5 more shares the same day at $89. I netted around $155, which is around 15% in a couple days. And if you do the math and kind of divide the total gain by the amount of days I was in the trade, it works out to around $12 a day, and it's totally passive. And this is how I like to make my money. I like to take these swing trades, and hopefully they go my way and I make money. Alright, I was editing the video and I realized I didn't discuss the risks of the trading strategy, and I want to do that now. So shorting a stock is always very risky because your potential downside, the amount of money you could lose, is infinite, right? So if you go long a stock, if you buy a stock, the most amount of money you could lose is all your investment, because the stock could just go down to zero. So if you put in $100, the most you could lose is $100. By going short a stock, the amount you could lose is infinite, because the stock could keep going higher and higher and higher, and your loss will just keep going higher and higher and higher. So very easily, Dollar Tree, the stock I shorted, could have went higher and I could have lost money. What I would have done is had a stop loss at kind of the high of that trend. So if I saw that it was actually going to make a new high and keep going up, I would have sold or bought my shares, covered, and closed my position. But it's important to note the risks of every type of strategy and every type of trade. Obviously, all these trades that I take don't work out. Some of them don't, and I'll make videos on some that don't. But the idea is that your wins will outweigh your losses, and then you have a sort of business and a sort of way to kind of increase your revenue. If you enjoyed this video, like the video, comment down below if you took a swing trade and how, what your experience was with it. And if you have not already, hit the subscribe button. It takes 0.0002 seconds, and every subscription for me is another step in my journey to